Okay, so it's early 2026 and a massive financial storm is brewing over in China. We're seeing their markets take a serious nosedive, and now those shockwaves are starting to ripple out across the globe. What's crazy is that Beijing is now thinking about a move so drastic it was once considered pretty much impossible. Let's get right into it and break down exactly what is going on.
The numbers we're seeing are just staggering. Foreign investors are yanking billions upon billions of dollars out of Chinese stocks, bonds, you name it. And look, this isn't a slow leak, it's a full-on flood. This is a huge vote of no confidence from the global community, and it is happening incredibly fast.
And this is where things get really serious. To stop the bleeding, Beijing is reportedly thinking about using the financial world's version of the nuclear option, just freezing the entire market, halting all trading. The very fact that this is even on the table tells you everything you need to know about how bad this crisis is.
So let's set the scene. You've got stock markets in Shanghai and Shenzhen hitting lows we haven't seen in years. And it's all being driven by this very real panic from investors around the world. But the big question is, why should a panic in China matter to the rest of us?
Well, you might be asking, why does a stock market drop in Shanghai matter to someone in, say, Ohio or Berlin? It's because China is so deeply woven into the very fabric of the global economy. I mean, think about it. Major companies in the US and Europe rely on China for everything from manufacturing their products to selling them. A crisis there directly hits their bottom line, which in turn hits global markets and, yeah, even your pension fund.
So that brings us right to the heart of it. What is causing this mass exodus? Why are investors who used to be so excited about China now sprinting for the exit? It's not just one thing, but really a perfect storm of a few critical problems all hitting at once.
You can really boil it down to four main triggers. First, China's economic engine is just sputtering. Second, that slowdown is causing a major loss of confidence. Third, that property crisis that's been simmering for years, it's finally boiling over. And fourth, investors are just spooked by a history of unpredictable government policies. And you can see how these fears are based on very real, very tangible problems. Just look at the chain reaction here. People in China stop spending as much, so factories slow down, and then exports fall. At the exact same time, the property bubble is bursting. You've got developers going bankrupt, home prices are falling off a cliff, and the banks are stuck with all these unpaid loans. It's a mess.
And that gets us to that policy uncertainty I mentioned. Investors have long memories. They haven't forgotten the sudden crackdowns on big sectors like tech and education, where entire industries were basically turned upside down overnight by a government decision. That history creates a huge trust problem. I mean, how can you invest for the long haul when the rules of the game can just change without any warning?
So with all this panic building up, the government is looking at its most powerful and, frankly, scary tool, the market freeze. The name itself sounds pretty extreme, right? Well, that's because it absolutely is. It's a totally fair question, and it's one that investors all over the globe are asking themselves right now. What does it actually mean to freeze an entire market?
At its core, it's just a trading halt. The government basically hits a giant pause button. Nobody can buy, and more importantly, nobody can sell. It's like pulling the emergency brake on a runaway train of panic selling. The idea is to give everyone a chance to breathe and let the policymakers try to get things under control.
But here's the crucial point. This creates a massive dilemma. On the one hand, yeah, a freeze could stop a total meltdown. But on the other hand, it literally traps investors' money. You can't get it out. This does serious damage to a country's reputation as a safe place to invest. And maybe worst of all, it sends a giant signal to the rest of the world that things internally are really bad.
Now, this whole crisis isn't happening in a vacuum. The shockwaves are already hitting shores all over the planet. So let's take a look at how different parts of the world are reacting to all this chaos.
So, who's most exposed here? Well, the European Union for sure, especially big export economies like Germany. They're deeply connected. The United States and the rest of Asia are right there with them. We're talking about trillions of dollars in trade and investment that tie these economies directly to whatever happens in China.
Let's break this down even further. In the US, you're seeing big-name companies on the S&P 500 feeling the heat. Over in Europe, it's the exporters and the banks that are getting nervous. For a country like India, it's kind of a double-edged sword. They're seeing some volatility, but they could also benefit if investors start looking for a new place to put their money. And all across Asia, from Japan to Singapore, currencies are under pressure as investors run for safety.
And it's not just about stocks.
As China's economy gets weaker, so does its currency, the yuan. Now, a cheaper yuan makes Chinese goods cheaper for the rest of the world, which puts a ton of pressure on manufacturers everywhere else. It sends a ripple through the entire global trading system, and it can actually affect the price of stuff on store shelves right here at home.
So all of this brings us to the final and most critical question. With everything that's at stake, what does the rest of 2026 even look like? The honest answer is nobody knows for sure. The path from here could go in a couple of wildly different directions.
Here are the two potential futures we're looking at. In the best-case scenario, the Chinese government somehow finds the perfect mix of policies to calm things down, confidence slowly starts to come back, and we avoid a major global crisis. But in the worst-case scenario, that market freeze completely backfires, trapping capital and setting off a domino effect of debt defaults that could throw the entire world into a long and painful period of volatility.
And that really leaves us with the ultimate dilemma, not just for policymakers in Beijing, but for investors all around the world. Is a drastic step like a market freeze a necessary evil to stop a complete collapse? Or is it a trap that, once you step into it, has no easy way out? The answer to that question is probably going to define the global economy for the rest of the year.